Well, clearly the banking sector is certainly living in interesting times, to use the old Chinese proverb. I think at the moment it is quite hard to predict what the events of the next 24 hours or 48 hours might be. But I think people shouldn't panic or get particularly nervous about it. I mean, we've seen the governments intervene where it's appropriate, and there are an awful lot of banks out there that are still extremely well funded. The challenge, I think, is that certain institutions, perhaps over the last few years, have been relying on access to the debt capital markets for supporting the growth of their business. And when those markets are no longer open, then obviously they have no way of putting money out there to lend to customers. And that's what causes a problem for the economy. I mean, I think the outlook for the property sector, the residential property sector, isn't great. I mean, the consensus forecast that I see suggests that the market will fall by about 25% from its high, and most people's view is we're about 10% off already, so there's clearly some further substantial falls built in. Now, there's some mortgage suppliers that have traditionally been quite aggressive in the market have effectively withdrawn, and that's reduced the supply of mortgages available. Those banks that are still lending, the likes of Abbey National, Lloyds, HSBC, Barclays, in many ways they all see it as an opportunity to grow their share of the mortgage market. But if they've got less competitors around, inevitably they're going to try and do the deals for the better quality customers, the prime borrowers. And that's going to make the availability of mortgages for people who want something like a high earnings multiple or a high loan to value, or they're perhaps subprime, those sorts of mortgages are going to be very scarce or indeed very expensive. Clearly, at the same time, though, you've got a bunch of consumers who are seeing all their costs go up, be it taxation, fuel, food, etc. And when they're seeing property prices fall, their confidence about buying is fundamentally shaken. So, the property market really gets hit in two ways. Well, one of the things that I think we're very fortunate about in Barclays is we learned a lesson in the early 90s and during the last major downturn that it's important to be consistent about your lending standards and never get carried away in the boom times. One of the things that means for us is actually we're not really having to change our standards about how we approach house building customers or indeed the mortgage market. We were sensible in the early 2000s, indeed some people called us conservative, but actually I think that strategy is proving the right one for the customer, where they're getting a consistent experience from us, and also the right one for the shareholder as well.